Welcome to the Explainer. Today, we're going to put on our financial advisor hats to explore a really powerful framework. It's been around for centuries, but it's incredibly relevant today. It's all about ethical, low leverage investing, and the rulebook we're going to use might just surprise you. So let's start with a big question for every single modern investor out there. How do you build a portfolio that actually reflects your values and, at the same time, is tough enough to withstand the risks that come with too much debt? It's a real challenge, but it turns out ancient wisdom might just have the answer. And get this, the answer might be hiding in a framework that already guides over $4 trillion in global assets. So, no, this is not some tiny niche strategy. It's a massive and, frankly, fast-growing piece of the financial world. Okay, so what is this framework? It's Sharia-compliant finance, and it operates on a really strict set of principles, starting with one foundational rule that completely changes how you think about money. At its very core is the absolute prohibition of riba, which is just a word for interest. Now think about what that means for an investor. It immediately takes some of the most common tools right off the table. No government bonds, no corporate bonds, not even a simple high-yield savings account. It forces you to find returns from real economic activity, not just from lending money. And the rules don't stop there. Beyond just interest, entire industries, we're talking alcohol, tobacco, gambling, they're all screened out from the get-go. This basically creates a pre-filtered universe of companies, drawing a very clear ethical line in the sand. So how do you actually take these rules and build a portfolio? Well, it's not guesswork. It's a systematic, quantitative screening process that has three very distinct layers. Let's dive into how this actually works. The whole process has three layers. First, you look at a company's main business. Second, you analyze its financial health, specifically how much debt it has. And third, you have to purify the income it generates. The first step is the business screen, and it uses a super clear quantitative rule. If a company makes more than 5% of its money from one of those prohibited industries we just saw, it's out. Simple as that. And this 5% rule is crucial because, let's be honest, in today's economy, very few large companies are 100% pure. Even a big tech company earns a little bit of interest on its cash. Now, the second screen is all about the numbers. And from a financial advisor's point of view, this is where it gets really interesting as a risk management tool. It's a hard and fast rule on how much debt a company is allowed to carry. And here it is, the magic number, 33%. A company's total interest-bearing debt cannot be more than a third of its total value on the stock market. This one simple ratio is an incredibly powerful filter. It automatically kicks out companies that are highly leveraged and therefore potentially a lot riskier. Think about market downturns. They're often sparked by companies with way too much debt. This is like a built-in defense mechanism. Okay, finally, the third layer, purification. Remember that small, less than 5% slice of impure income a company might earn, like, say, interest from cash just sitting in a bank account? Well, this rule says you can't personally profit from that, so you have to calculate what tiny fraction of your dividend came from that interest, and you donate that exact amount to charity. It's the final step to make sure the return you actually keep is ethically clean. Now, all of this might sound like a lot of constraints, a lot of rules. But here's the aha moment. These rules are not just about ethics. When you put them all together, they actually form a really powerful financial strategy for managing risk. This right here is the key insight. That rule against having too much debt, it isn't just a moral position, it functionally becomes a conservative financial guardrail. It's designed to protect the portfolio from companies that have bitten off more than they can chew. In short, the ethics becomes the risk management. And this just brilliantly shows the difference in thinking. A typical market index, it's totally blind to how much debt a company has. It only cares about size. But this approach makes low debt a non-negotiable requirement just to get in the door. Financial stability isn't an afterthought, it's a prerequisite. So, what does this intense filtering process actually do to a portfolio out in the real world? Well, it fundamentally changes its genetic makeup. It gives it a completely different look and feel compared to the rest of the market. The impact on the portfolio is, well, it's dramatic. If you look at the chart, you'll see the entire financial sector, that huge chunk of a conventional index, is basically gone in the compliant portfolio. To make up for it, the strategy naturally becomes overweight in sectors that usually carry less debt, like technology and healthcare. The whole structure of the portfolio shifts. So this structural tilt means that performance is naturally going to zig while the broader market zags. When the banks are soaring, yeah, this kind of portfolio might lag behind. But when technology and healthcare are leading the charge, it could very well outperform. It creates its own unique risk and return profile. Now, it is really important to understand that this is not a set it and forget it strategy. Because a company's financial health can change pretty quickly, the portfolio needs active monitoring. For instance, if a company's stock price tanks, its debt-to-market-cap ratio could suddenly shoot over that 33% limit. And when that happens, the rules say you have to sell it within a certain time frame. It takes real discipline. So why does any of this matter if you're not a Muslim investor? Because when you really break it all down, the principles underneath have a universal appeal for pretty much anyone interested in responsible investing. I mean, the parallels to modern ethical investing are just impossible to ignore. Avoiding industries like tobacco and alcohol, that's exactly what sin stock exclusion is. Screening for low debt, that's a powerful form of governance, the G in ESG. And focusing on real tangible assets instead of complex derivatives lines up perfectly with the push for transparency and real-world impact. The language is different, sure, but the goals are remarkably similar. Which kind of leaves us with this final thought. In a world of increasing complexity and, let's face it, volatility, maybe the most durable, most resilient portfolios are the ones that are built on a solid foundation of values. It's a powerful idea, and it leads to a pretty fundamental question about where we're all headed.